So let's talk about Texas Roadhouse. We're diving into their Q4 earnings call, and on the surface, things looked, well, not great. But then the stock popped. It's a bit of a head scratcher, right? Let's get into the story behind what really happened. Okay, so here's where it gets really interesting. On one hand, you've got the results. Texas Roadhouse missed the earnings per share target by 24 cents. They also came up short on revenue by a full 18 million bucks. Not exactly what you want to see. But then, look at the reaction. The stock actually rallied 3.5% after hours. So what on earth did investors see that the headline numbers were hiding? And that's the billion-dollar question, isn't it? Why reward a miss? Well, here's the thing. This wasn't about rewarding a bad quarter. This was about Wall Street looking right past the rearview mirror and focusing, really focusing on the road ahead. So let's unpack the exact signals management sent that got everyone so optimistic. All right, first things first, we have to understand the numbers that initially spooked people. And let me tell you, this was a quarter where costs put a serious squeeze on the business. First up, earnings per share, or EPS. The company pulled in $1.28. Now, Wall Street was expecting $1.52. That's a nearly 16% miss. For a company like Texas Roadhouse, which is usually known for being rock solid, that's a pretty big deal. And here's where we start to see the why. This number points to the core problem. The restaurant-level margin, that's the profit they make at each location, it fell by 309 basis points, or to put it simply, 3.09 percentage points. That means for every dollar coming in, less and less was making it to the bottom line. So where did all that money go? And boom, here is the culprit. The cost of their food, especially beef, just went through the roof, up 9.5% in just one quarter. That is an incredible amount of inflation to try and swallow. The takeaway here is simple. Operationally, Q4 was a really tough fight. So if Q4 was such a struggle, we're back to our main question. Why did the stock go up? Well, you always have to remember the market is a forward-looking machine. It's all about what's next. And investors listened to management's game plan for the coming year, and they absolutely loved what they heard. And look, management wasn't trying to hide anything. They came right out and said that this pressure from beef prices isn't just going to disappear overnight. And you know what? That kind of honesty, that transparency, it goes a long way. It tells investors you have a realistic plan. So investors basically just brushed off the Q4 margin story and honed in on 4 huge positives. 1, an absolutely explosive start to the new year. 2, a really smart, disciplined approach to pricing. 3, they're still opening new stores like clockwork. And 4, they're strategically buying back franchise locations, which gives them more control. Okay, now this right here was probably the single most important number in the entire announcement. In Q4, sales at existing stores were up a solid 4.2%. Good, right? Well, in the first 7 weeks of the new year, that number accelerated to an incredible 8.2%. It nearly doubled. This shows that customers are flooding in and the momentum is building, not fading. So how are they getting all these people in the door? By protecting their reputation for value. Think about it. Their food costs shot up almost 10%, but instead of just passing that all on to you, they're only raising prices by about 1.9%. They're playing the long game here, choosing to keep their restaurants packed by being the best deal in town, even if it hurts margins for a bit. So let's put all the pieces together. Here at Talk Tickers, this is our official take on what this all means for the next quarter and what we think about the stock right now. Okay, looking into our crystal ball for Q1, we see that incredible sales momentum continuing. We're forecasting comp sales to land around 7.5%. Now, margins are still going to be a little tight because of those beef costs, but we see them bouncing back to around 15%. That should all lead to some solid growth, with an EPS around $1.60. So with all that said, we're initiating our rating at market perform. The bull case is clear. The customer traffic story is fantastic. But after that big stock pop, we think that good news is now pretty much baked into the price. The valuation feels fair, but not cheap. So how could you play this? Well, given the lingering uncertainty out there, here's a trade idea. You could consider selling something called a cash-secured put. Now, in simple terms, this means you get paid a little cash, that's the premium, for agreeing to buy the stock at a lower price if it happens to dip. It's a strategy to either just earn some income while you wait, or potentially get into a great company at an even better price. And of course, we have to end with our usual reminder. Everything we've discussed here today is for informational and educational purposes only. This is not financial advice. Please be sure to do your own homework before making any investment decisions.